Gold just collapsed, $4,115 per ounce, down 3.2% in hours. February 12th, 2026, silver fell 10.8%, platinum dropped 6.2%, $6 trillion wiped from precious metals. And nobody is asking the right question. Welcome to Market Flux. I break down what is actually happening in markets while the mainstream media keeps you distracted. Subscribe right now because what I am about to show you rewrites everything you thought you knew about safe haven assets. Here is what happened. February 12th, 2026, 4:02 p.m. Eastern Time. Gold hit $4,015.74 per ounce. That is a 3.2% drop in one session. From trading above $5,000, the exact level that held for weeks. But here's the data point everyone missed. On February 11th, the U.S. released January jobs data. Non-farm payrolls rose 130,000. That is higher than expected. Unemployment dropped to 4.3% from 4.4% in December. Initial jobless claims fell to their lowest in months. Higher rates mean higher opportunity cost for holding gold. Gold pays no interest. Treasury bonds do. When rates stay high, capital rotates out of gold. But that is the surface story. The one CNBC will tell you. The one Bloomberg headlines push. Now let me show you what actually happened. There's a mechanism at work. Most retail investors do not understand it. It is called stop-loss cascading, and it turned a 2% dip into a 3.2% crash. Think of it like a row of dominoes. Each domino is a stop-loss order. Traders place them below key psychological levels, below $5,000 in this case. When price breaks that level, those orders trigger automatically. They become market sell orders. That selling pressure pushes price lower, which triggers the next layer of stops, below $4,950. Then $4,920, then $4,900. Each wave creates more selling. Price falls faster. Fawad Razakzada, analyst at City Index, confirmed it. A lot of people placed stops below $5,000 to preserve positions. Those stops got triggered. That caused a cascading effect. This is not theory. This is documented. January 29th, 2026. Gold hit $5,595 per ounce. Record high. Then dropped 21.3% in 4 days. To $4,404. Same mechanism. Silver lost 40% from its peak. In the same window, this is the third major cascade since gold broke $5,000. Now, here's reason number one this happened. Volatility created fear. When gold jumped from $4,350s in early January to $5,600 by January 29th, that is a 30% move in 4 weeks. Traders got nervous. They tightened their risk management. They placed stops closer to current price. That compressed the stop-loss layers. So when price dropped, even slightly, it hit multiple stop layers at once, creating the cascade. This is why the drop was so fast. Silver futures margins jumped from 11% to 15%. Effective aftermarket close on February 12th. Higher margins mean traders need more capital to hold positions. Some traders could not meet the new requirement. They were forced to close positions. That added selling pressure right before the February 12th crash. Reason number three, speculative positioning was extreme. Net long futures positions hit their highest level since 2020. Short positions hit their lowest since 2020. That means everyone was positioned the same way. Long gold. When a market is one-sided, any negative catalyst creates a stampede for the exits. There is no liquidity on the other side. No buyers to absorb selling. Price gaps down. Fast. This is exactly what happened February 12th. Now, here's what you were not told. While retail investors were panic selling at $4,915s, central banks kept buying. Let me show you the numbers. Full year 2025, central banks bought 863 tons of gold. That is below the 1,000 plus ton pace of 2022, 2023, and 2024, but still 82% above the 2010-2021 average. National Bank of Poland bought 102 tons in 2025, largest buyer for the second consecutive year. National Bank of Kazakhstan added 57 tons, their highest annual total on record since 1993. Central Bank of Brazil re-entered the market after 4 years, added 43 tons between September and November 2025. State Oil Fund of Azerbaijan bought 38 tons. In November 2025 alone, central banks bought 45 tons. Poland added 12 tons. Brazil added 11 tons. Uzbekistan, Kazakhstan, Czech Republic, China, Indonesia all bought. JP Morgan forecasts 755 tons of central bank buying in 2026. That is 26% of annual mine output. Every quarter, central banks need to buy 190 tons just to maintain their diversification targets. Goldman Sachs expects central bank demand to remain the structural floor under gold prices. They call central banks structural dip buyers. That means they buy more when price drops. This is the opposite of retail behavior. Retail panics and sells on dips. Central banks add on dips. Why? Because they are not trading. They are rebalancing reserves away from dollars. At current prices around $4,900, central banks do not need to buy as many tons to hit their percentage targets, but they are still buying. That tells you the diversification trend has not stopped. Now here is the disconnect. While you were watching gold crash on February 12th, you were being told a narrative. Strong economy means gold goes down. But that is not what the data shows. U.S. fiscal deficit hit $838 billion in the first 4 months of fiscal year 2025. That is accelerating spending, not slowing. Moody's downgraded the U.S. credit rating in 2025. That removed the last AAA rating the U.S. held. National debt keeps climbing. Real interest rates are still near zero when you account for inflation. And central banks are buying gold at near record pace. So what are they seeing that retail investors are missing? They are seeing dollar risk, currency debasement risk. They are seeing a world where the Federal Reserve's independence is questioned, where Trump nominated Kevin Warsh to replace Jerome Powell, where monetary policy becomes political. They are seeing de-dollarization accelerate. China's foreign exchange reserves stood at $3.2 trillion in March 2025. $784 billion of that is in U.S. Treasury bonds. Down from previous years, Russia, China, Brazil, Kazakhstan, Poland, Turkey, all increasing gold reserves, all reducing dollar exposure. This is not speculation. This is IMF data. So here's what actually happened on February 12th. Yes, jobs data was strong. Yes, that triggered technical selling. But the bigger story is the gap. The gap between what retail investors are doing and what central banks are doing. Retail is trading. Central banks are positioning for systemic change. Now, here's where it gets interesting, because this exact pattern has happened before. And what came next shocked everyone who sold the dip. January 29th, 2026, gold hit $595 per ounce, all-time record high, then crashed 21.3% in 4 days, down to $44.14. Panic everywhere. Reddit forums filled with gold is dead posts, YouTube thumbnails screaming bubble popped. Retail investors capitulated, sold at the bottom. Then what happened? Gold recovered to $5,080 within 2 weeks. By February 12th, it was back at $4,115, still down from the peak, but up 11.6% from the crash low. The people who sold at $4,400 watched the recovery from the sidelines. The people who held or bought the dip made 11.6% in 14 days. This is not the first time. March 2023, gold hit $250, then dropped to $1,930 in 5 sessions. 5.8% crash, everyone panicked. 6 months later, gold was at $2,135, up 10.5% from the panic low. December 2023, gold crashed from $2,072 to $1,973, another 4.8% drop. By October 2024, gold was at $2,950, up 39.8% from that December low. The pattern is clear: sharp crash, retail panic, slow recovery, new highs. Why does this keep happening? Because the fundamentals have not changed. Well, let me show you what is still intact right now. February 16th, 2026, fundamental number 1. Central bank buying remains structural, 745 tons, forecasted for 2026 according to JP Morgan. That is 26% of global mine production. Poland bought 102 tons in 2025. Kazakhstan bought 57 tons. Brazil re-entered after 4 years. These are not short-term trades. These are multi-year reserve reallocations. As long as geopolitical fragmentation continues, central banks will keep buying. As long as the dollar weaponization narrative persists, de-dollarization accelerates. Gold is the alternative. Fundamental number 2, supply remains constrained. Global mine production has been flat since 2018, around 3,000 tons per year. No major new discoveries. Recycling supply dropped in 2025 as prices rose. People hold physical gold longer when they expect higher prices. That tightens available supply even more. Fundamental number 3. Real interest rates are not as high as headlines suggest. Yes, nominal rates are elevated, but inflation is still running above 3% in the US. Real rates are near 2%. That is historically low. In the 1980s, real rates hit 8%. In the 1990s, they averaged 4%. At 2%, the opportunity cost of holding gold is manageable. Fundamental number 4, U.S. fiscal trajectory is unsustainable. $838 billion deficit in 4 months of fiscal year 2025. That projects to over $2.5 trillion annually. Debt to GDP ratio is above 120%. Interest payments on the debt now exceed $1 trillion per year. That is more than defense spending. This does not reverse without major policy change. And policy change looks unlikely. Both political parties favor spending. Infrastructure bills, defense bills, social programs, tax cuts, all deficit financed. On the record, Screenshot this. Gold will hit $5,800 per ounce by December 31st, 2026. That is 18.4% above current levels of $4,900. Why? Because the January crash reset speculative positioning, leveraged traders got flushed out, margin requirements increased, weak hands sold. The market is cleaner now. When gold ran from 4,150 to 5,595 in January, that was too fast. It needed a reset. The February 12th drop to $4,150 is that reset. Now gold can climb again, but slower, steadier, supported by physical demand from central banks and Asian buyers. Not driven by speculation. The path is not straight up. There will be volatility, but by year end, $5,800 is the target. Here's how we get there. Scenario 1, steady grind higher, probability 60%. Gold climbs $100 per month from March through December, reaches $5,900 by year end. This happens if the Federal Reserve cuts rates twice in 2026, if inflation stays above 3%, if central bank buying continues at current pace, if geopolitical tensions remain elevated but do not escalate. This is the base case. Slow, boring, profitable. Scenario 2, volatile consolidation, then breakout. Probability 30%. Gold trades in a $4,700 to $5,200 range through summer, then breaks out in Q4. This happens if the Federal Reserve pauses rate cuts, if economic data stays mixed, if stock markets remain stable through mid-year. Then in Q4, a catalyst hits. Maybe a debt ceiling crisis, maybe a geopolitical shock, maybe a banking stress event. Gold spikes to $6,000 in November or December. Scenario 3, retest to $4,400 first, probability 10%. Gold drops back to January lows before recovering. This only happens if the Federal Reserve signals rate hikes, or if stock markets crash and gold gets sold for liquidity, or if China dumps gold reserves to defend the yuan. Unlikely, but possible. Even in this scenario, gold recovers to 5,500 plus by year end because the fundamentals force a rebound, just a scarier path to get there. Now here's what you should do. Depends on who you are. Let me break it down by position. If you are holding physical gold, do nothing. You're fine. Physical gold is insurance, not a trade. The 3.2% drop on February 12th does not matter. You are positioned for systemic risk. Currency debasement, banking crises, geopolitical shocks, none of that changed. Your thesis is intact. Hold. If you are trading gold on leverage, you need to reassess risk management. The cascading stop-loss events on January 29th and February 12th prove the market is volatile. Tighten your stops, but give them room below technical levels. Do not place stops at obvious round numbers like $4,900 or $5,000. That is where cascades start. Use 5% to 8% stop losses from entry. And reduce position size. If you are trading 10 contracts, trade 5. Volatility is not going away. If you are sitting on cash, you have two options. Dollar cost average starting now. Buy small amounts every week or month from $4,900 to $5,200, or wait for a retest. If gold drops back toward $4,700, that is your entry. Set alerts, be ready, but do not wait forever. The next move could be straight up. If you bought at the top, near $5,600 in January, you are down 12% to 14%. This is painful, but do not panic sell now. History shows gold recovers from these crashes. It might take 6 months, it might take 12 months, but $5,600 will be retested, probably exceeded. Average down if you have capital. If not, hold and wait. The worst decision is selling at $4,900 and watching it climb back to $5,800. Now here is what to watch going forward. Indicator number 1, the DXY dollar index, currently around 106. If it breaks below 104, gold rallies. If it breaks above 108, gold struggles. Strong dollar equals pressure on gold. Weak dollar equals tailwind for gold. Watch this daily. It is the most important correlation right now. Indicator number 2, COMEX gold inventory levels. Registered inventory available for delivery. If this drops below 700,000 ounces, physical tightness accelerates. That forces futures prices higher to attract physical supply. We saw this in 2020 and 2021. Watch for inventory drawdowns. Indicator number 3, central bank purchase reports. IMF releases quarterly data. If Poland, Kazakhstan, or China accelerate buying, that is bullish. If buying slows, gold consolidates longer. Indicator number 4, Federal Reserve plot. Next one is March 19th, 2026. If Fed members project 2 rate cuts in 2026, gold rallies. If they project 0 cuts, gold corrects further. Now let me tell you about 3 types of people watching this video. The first type is panicking. They see the 3.2% drop and think the bull market is over. They are about to sell, or already sold. They will miss the recovery. They will buy back higher. They will lose money both ways. The second type is frozen. They do not know what to do. Hold or sell. Buy more or wait. They are paralyzed by indecision. They will do nothing, which is better than panicking, but they will miss the opportunity to average down or add on weakness. The third type is learning and preparing. They understand this is a technical shakeout, not a fundamental breakdown. They see the central bank buying, the supply constraints, the fiscal mess. They are using this volatility to position better. They are the ones who will profit when gold hits $500 to $800 by December. Which type are you? Markets do not reward emotion. They reward preparation. The February 12th crash moved wealth from the panic to the patient, from the leverage to the prepared. This is how every bull market works. 2 steps forward, 1 step back. Retail sells the dip, institutions buy the dip, wealth transfers. Remember the opening, gold crashed. 49 to 115, nobody asked the right question. Now you know the question, why are central banks buying while retail is selling? That question answers everything. The crash was technical. The trend is fundamental. The people who understand the difference will win. Hit the like button right now. Subscribe to Market Flux. Share this with someone who panic sold gold last week. They need to see this. Drop this exact phrase in the comments. I am the third type. Let me know you are positioning for what is coming, not reacting to what just happened.